Warren Buffett has emphasized many times that risk does not come from volatility, but from not understanding what you are paying for. After years of closely watching how he views the market, I realize Buffett is always particularly cautious when all of Wall Street rushes into a big story with massive spending and almost perfect expectations. And looking at the current AI wave with hundreds of billions of dollars poured in within a short time, that familiar feeling reappears. Not because this technology is meaningless, but because history shows it is precisely the moments when everyone is certain they are right that risks begin to accumulate. Once Warren Buffett shared a story with me when we sat together in the final days of 2025. He said that at that time he was witnessing the largest tech companies in America spending $400 billion on AI infrastructure in just 1 year. Not 40, not 100. It was $400 billion, a number large enough to make any sober investor stop. Microsoft, Amazon, Google, Meta, from the way he observed it, they were all rushing into a race to build data centers on a scale that could cover all of Manhattan. Chips were being bought at a speed as if tomorrow would not exist. Deals worth hundreds of billions of dollars were signed with companies that had not even proven their revenue. And when telling this part, Buffett said the feeling inside him at that time was very familiar, a feeling he had experienced in 1999. He reminded me that he was 95 years old, having gone through enough market cycles to draw a simple truth. When everyone is running in the same direction, the wise thing is not to run faster, but to turn back and see what is making them so panicked, because very often the crowd is not running toward opportunity, but is unconsciously running toward the edge of a cliff. Buffett does not deny the AI revolution. He admits it is a real technological advancement with long-term impact. But according to the way he looked at the market then, what was happening was no longer pure investment. It was speculation, only this time it was dressed in a three-piece suit, presented with polished slides and very clever language. And as he once told me, history has never been forgiving to speculation, regardless of how smart the participants believe they are. Once Buffett told me to go back in time with him to the year 1999. At that time, he said he was sitting in his familiar office in Omaha, opening the newspaper every day to see stories about internet companies with no profit, no clear product, and sometimes not even a complete business plan, but valued by the market at levels that left people stunned. Pets.com, he recalled, had only a sock puppet and an inflated dream, but still became a symbol of the future. Webvan was praised for revolutionizing how people shop for groceries. The Globe.com, founded by two college students with a mere $15,000, saw its stock price soar 606% on the first day of trading, even though the company had not generated a single dollar of revenue. Buffett said that what he remembered most was not the numbers, but how people looked at him at that time. They said Warren had lost his judgment, that he no longer understood the new economy, that the old man from Omaha was past his prime. He laughed when recalling a particularly uncomfortable dinner party where a young venture investor, probably not over 30, confidently told him he was making the biggest mistake of his career by not investing in internet stocks. Buffett told me he still remembers that sentence very clearly. Warren, this time is different. Internet will change everything. And in a very calm way, he admitted the young man was half right. The internet truly changed the world. But it did not change the basic laws of economics. Businesses still need to create value. Profit still matters. And price eventually must return to reality. Then Buffett paused as if to emphasize the ending that history wrote itself. By 2002, the NASDAQ index lost 78% of its value. Dreams valued in stocks vanished faster than internet speeds back then. As for that young venture investor, according to what Buffett heard later, he went back to work at his father's car dealership. Not because he was stupid, Buffett said, but because he believed that this time the old rules no longer applied. Buffett looked at me and slowly pulled the story back to the present. He said, "Now look at what is happening before our eyes. NVIDIA just touched a market cap of $5 trillion. $5 trillion for a company that makes chips. OpenAI is valued at about $500 billion, while expected revenue for 2025 is only about $1.13 billion. Buffett emphasized that this does not require a complex financial model. Even his fifth-grade math teacher could see this calculation does not add up. He continued, and this is the part that truly made him feel uneasy. The financial vortex is feeding itself. NVIDIA invests tens of billions of dollars in OpenAI. OpenAI then uses that very money to buy chips from NVIDIA. Oracle builds unfinished data centers using money that OpenAI has never earned. Buffett paused and said he had seen this model before, not once. He took me back to the late 1990s when telecommunications companies like Global Crossing or Level 3 Communications rushed to deploy fiber optics at a frantic pace. They lent money to customers to buy their services. Customers used those loans to buy more capacity, and so revenue on paper soared. Stock prices climbed. Everyone believed they were a genius. Then the bubble burst. 4 years later, from 85 to 95% of that fiber optic cable still lay idle underground, completely unused. Corning, the world's largest fiber optic manufacturer, saw its stock drop from $100 to $1. Buffett spoke very softly, almost as an explanation rather than a boast. He did not invest in any of those companies, not because he was smarter, but because he did not understand how they would make money. That was when Buffett repeated the principle that has followed him for over 70 years, the circle of competence. If he does not understand a business model, he will not invest in it. Someone asked him if he had missed the internet boom. He admitted that was true. Amazon, Google, Microsoft became giants. But Buffett said he completely accepted that, because for every Amazon that exists, hundreds of pets.com have disappeared. And he concluded the graveyard of .com companies is full of investors who once believed they were smarter than everyone else. Buffett said, "This is what most people always get wrong about bubbles. They are rarely built on total lies. They always start with the truth. The internet truly created a revolution. E-commerce truly changed the retail industry. Cloud computing truly transformed how businesses operate." Buffett does not deny any of that, but he emphasized that the important question has never been whether the technology works or not. The only question is how much you are paying for it. He repeated a number that he thought everyone should read slowly. In the year 2000, the NASDAQ index traded at a price-to-earnings ratio of over 200 times. Buffett paused, then said that single number was enough to explain everything that happened afterward. Today, we have not returned to that extreme level, but he does not feel more at ease because of it. The Shiller PE ratio for the S&P 500 is currently around 40, approaching the third highest level in 154 years of market history. But according to Buffett, what truly worries him is not a single index. The problem lies in the level of concentration. About 80% of the market's gains today come from just a very small group of tech stocks, the so-called Magnificent Seven: NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla. They account for 75% of the profits of the entire S&P 500 index. Buffett said that is no longer a proper market. It is a house built of cards. He continued with data that is becoming harder to ignore. Capital spending related to artificial intelligence now accounts for more than half of the U.S. GDP growth in the first half of 2025. Buffett repeated this again very slowly. Not consumer spending, not broad business investment, but a single technological trend carrying most of the growth for the entire economy. Buffett said that in his entire investing life, he had seen such a level of concentration exactly twice. The first was the Nifty 50 bubble in the early 1970s. The second was 1,999 with tech stocks. And in his words, both times ended the same way, not with debate, but with tears. He thought venture capital data was even more concerning. Nearly 64% of total U.S. venture capital in the first half of 2025 flowed into AI companies. For comparison, at the peak of the dot-com bubble, internet deals accounted for only about 25%. Today, there are over 1,300 AI startups valued over $100 million and nearly 500 AI companies labeled as unicorns with valuations over $1 billion each. Buffett spoke very bluntly. Most of these companies are not profitable. In fact, about 70% of funded AI startups are still losing money. But their valuations continue to rise, not because of cash flow, but because of the fear of missing out. He looked at me and concluded with a very Omaha sentence. In his hometown, people do not call that investing, they call it gambling. Once Warren mentioned Charlie Munger during a very quiet conversation. Charlie once told him, "Warren, it is patience that is the greatest advantage of an investor." Warren told me that Charlie understood one thing that most of Wall Street never accepts. Money in the stock market does not come from doing more, but from waiting for the right time. Constant activity gives a sense of intelligence, but patience brings profit. Looking at the current picture, Warren sees many tech companies spending 22 to 30% of their revenue on capital expenditures, mainly to build AI infrastructure. This figure is 3 times higher than that of utility companies, which have stable, predictable cash flows and proven profitability over many decades. Meta is preparing to build a data center consuming more than 2 gigawatts of electricity, enough to power a small city just to run about 1.3 million NVIDIA GPUs. Warren paused at this point and asked his familiar question: for what? To train AI, models that may become obsolete in just 2 or 3 years. To gain an advantage in a race where every competitor is pouring in tens of billions of dollars with the vague hope that profits will come at a very distant point in the future. In Warren's view, this is no longer investment in the traditional sense. This is speculation on an industrial scale, a collective bet on the assumption that growth will come fast enough to justify spending levels unprecedented in corporate history. And then he returned to the number that truly makes him uneasy. For all this spending to create reasonable economic value, the AI industry would need to generate about $2 trillion in revenue annually by 2030. Currently, total industry revenue is only around $20 billion. That requires a growth of 100 times within 5 years. Not 100%, but 100 times. Warren told me he has been in the market since 1951. In those more than 7 decades, he has never seen any industry grow at such a pace while maintaining sustainable profits. As he put it, that is not just optimism, it is an expectation that defies the gravity of business. Once Warren told me that if there is one thing that never lies in investing, it is the numbers. You can paint them or polish them, but in the end, a business has only 2 states. Either it makes money or it does not. And as Warren looks at current balance sheets, the numbers in the AI sector simply do not add up. In fiscal year 2025, Microsoft, Amazon, Google, and Meta are expected to spend a total of about $364 billion on capital expenditures. These are not young companies trying their luck. These are the largest, most profitable corporations in modern history. And Warren remarked that they are spending money with the speed of drunken sailors who just got shore leave. Microsoft has raised its capital spending to over $120 billion for 2025. Amazon is at about $100 billion. Google adjusted its forecast up to $85 billion. Meta is spending over $70 billion and publicly stated that this will continue to rise sharply into 2026. Warren told me that the importance lies not in each individual number, but in the speed at which they are swelling. Microsoft's spending is 7 times higher than just 5 years ago. According to Warren, that is no longer normal growth, but a total change in the business model. And more importantly, it is a massive bet that this new model will succeed. But then he went back to the number he could not ignore. Despite all that massive spending, revenue related to AI currently still accounts for a very small part of total revenue. Microsoft reported AI revenue at an annual run rate of about $13 billion. It sounds impressive until you put it next to the $120 billion expenditure to create that number. Warren laughed lightly and told me it is no different than spending $9 just hoping to get $1 back. Of course, people will argue that this is investment for the long term, but according to him, there is always a very clear line between investment and speculation. Can you reasonably estimate the future return on that spending? If not, you are not investing, you are betting. He had seen this logic before. In the dot-com bubble, companies like Global Crossing spent over $15 billion to build a global fiber optic network. The reasoning then sounded perfectly logical. Internet traffic was growing, so capacity had to stay ahead. The problem was they built nearly 99% more than the demand. When the bubble burst, most of those assets became worthless. Warren said what makes his skin crawl is that the speed and scale of building AI infrastructure today is larger, faster, and more aggressive than that time. The similarity is not just a familiar feeling. According to him, it is almost a duplicate. Warren Buffett once shared a story that anyone who understands market history should feel uneasy hearing. It is the story of periods when corporate spending is no longer funded by cash flow but increasingly relies on debt. He mentioned Meta arranging about $27 billion in off-balance sheet financing as a very typical example. Companies are using leverage while placing huge bets on technologies that are still full of uncertainty. Investments that may not be profitable for many years or even never. Buffett told me that debt amplifies everything, both gains and losses. When things go well, debt makes you look smarter and get rich faster. But when the context changes, it is debt that determines who is still standing and who will be washed away. He once looked back at a very personal mistake in his early career. Buying Berkshire Hathaway stock not out of reason, but out of anger at management. It was a stock so cheap he thought he could take one more puff. That investment, driven by emotion rather than reason, cost him about $200 billion in opportunity costs over decades. It was the worst investment decision he ever made. The lesson is not in the numbers. It lies in the fact that even very smart people can make stupid decisions when they let emotions override reason. Looking at the current AI wave, the emotion clearly dominating is not long-term vision, but fear. Fear of missing out. Fear of falling behind. Fear that if you do not spend billions immediately, your company will become irrelevant. That is not a recipe for good capital allocation. It is panic disguised as strategy. Buffett told me when emotion dominates the market, look at the most uncomfortable numbers. OpenAI, the symbol of the AI revolution, is on track to lose several $1 billion this year despite its popularity. Despite partnerships with Microsoft and a $500 billion valuation, they are still losing heavily. Excessive costs force them to raise prices and cut computing costs. The entire AI startup ecosystem is built on the assumption that eventually these models will become profitable. History is under no obligation to confirm those assumptions. In the dot-com bubble, the market was obsessed with the concept of burn rate. Today, we see the same thing with AI companies. The only difference is that current capital is more abundant, so the burn can last longer. But the core problem has not changed. Spending more than earning is never a sustainable business model. Ray Dalio recently noted that bubble conditions are forming, but the bubble will not burst until monetary policy tightens. Buffett agrees with that logic. Low interest rates make capital cheap, but the important question is not if this will reverse, but when. When interest rates rise or the economy slows and investors start demanding profits instead of promises, the market will classify very quickly. And that is when people realize who has been swimming naked. Right now, in the AI pool, there are probably more people in that state than they realize. There is another similarity that Warren Buffett told me truly troubles him: the level of concentration. At the peak of the dot-com bubble, the 10 largest stocks accounted for about 27% of the total S&P 500. Today, that number has risen to 39%. Buffett emphasized that this is not just normal concentration, but a dangerous form of concentration. The problem is what will happen when they adjust. When that happens, not only will the tech sector be pulled down, but the entire market will be affected. Pension funds and index funds that people believe are safe are all holding stocks of the same group of companies. The average investor thinks they have diversified, but in reality, they are placing a massive gamble on about 10 businesses, most of which are spending unsustainable amounts on AI infrastructure. We have seen the end of this story before. After the dot-com bubble collapsed, the NASDAQ index took 15 years to return to its old peak. An entire generation of investors had to relearn the old lesson: trees cannot grow to the sky. But Buffett said the scariest thing is the gap between spending and revenue. In the past 2 years, big tech companies have poured about $560 billion into AI infrastructure. Meanwhile, total AI-related revenue for the top 5 tech giants is only around $35 billion. A 16-to-1 spending to revenue ratio. Buffett said he does not need to be a math genius to understand that you cannot spend $16 to make $1 and call that a good business plan. He admits some of these investments will bring returns, but history shows most will not. A recent study showed that 95% of AI pilot projects failed to create meaningful results despite $40 billion in investment. The gap between hype and reality is wider than the Grand Canyon. What worries him most is the psychology behind these decisions. It does not come from profit analysis, but from fear. The fear of being left behind if they do not act immediately. That is the exact psychology that inflated every major bubble in history. In his 2000 letter to shareholders, Buffett compared investors to Cinderella at the ball. They knew that if they stayed too long, everything would turn into pumpkins and mice, but they still did not want to leave even a minute early. Today, the music is called artificial intelligence. The party is very lively, the champagne is still flowing, but Buffett says he has attended enough parties to know they always end the same way. Someone will eventually have to pay the cleanup bill. People often ask what the secret to successful investing is, as if it must be a complex formula, but the reality is the opposite. The most important principle is extremely simple. Do not lose money. And the second principle is never forget the first principle. This is not philosophy. It is pure mathematics. Losing 50% of your capital means you need a 100% return just to get back to the starting line. It is a losing game from the beginning. And looking at current AI valuations, many investors are unintentionally accepting that very game. In history, periods of booming capital spending rarely bring good results for shareholders. A study of major cycles shows that businesses that massively expand their balance sheets often underperform cautious businesses by about 8% per year. That gap accumulates into a very real wealth disparity. The reason is simple. When every company rushes to build capacity, they create excess. Supply exceeds demand, prices fall, profits are eroded, and ultimately shareholders pay the price. That model is repeating. Tech corporations are investing in AI infrastructure at an unprecedented pace based on the assumption that future demand will be large enough, but good investing is not based on perfect assumptions. It is based on a margin of safety, a buffer for mistakes and delays. The problem of AI valuations today is that there is almost no buffer at all. Every number assumes everything goes smoothly. Technology advances. Competition is controlled. Demand grows uninterrupted. History shows those are very fragile assumptions. Cisco was once the symbol of the internet era. Real revenue, real profit. But its stock still lost over 80% of its value and to this day has not returned to its peak after more than 2 decades. The lesson is not that the company was bad, but that the price you pay is more important than the quality you buy. This principle does not change just because new technology appears. AI will certainly change the world just as the internet did. But changing the world and creating sustainable investment profit do not always overlap. The market may vote for excitement in the short term, but in the long term, it always weighs by real profit. When that weighing occurs, valuations without a margin of safety will have to adjust. The important question is not whether AI is important. The question is how much are you paying for that future and whether you have enough room to endure when things do not go perfectly. So where does all this lead us? Before everything, it is necessary to clarify one thing. Artificial intelligence is not meaningless, and the companies leading it are truly serious. Nothing in this argument denies the potential of the technology. What is worth discussing is whether the expectations attached to stock prices exceed realistic capabilities. When you pay a price that demands absolute perfection, you are putting yourself in a very fragile position. My approach has not changed for decades. I find businesses that I can understand, buy them at a reasonable price, and demand a margin of safety large enough to protect myself. At this moment, most AI stocks do not meet those criteria. This does not mean I am definitely right. It is entirely possible that this time is different. Maybe AI will develop faster than any precedent, and every massive investment today will be rewarded. That could happen. But experience teaches me that the phrase, "this time is different," usually appears most frequently right before reality proves the opposite. Technology can change, but mathematics does not. If you lose half of your capital, you must double the remainder just to return to the initial point. That is not an opinion. That is a non-negotiable reality. Therefore, my number one priority is always capital preservation. That is also why Berkshire is holding a very large amount of cash. Many people consider that a waste of opportunity. They may be right in the short term, but cash brings you something incredibly valuable. The ability to act when others no longer have a choice. When the market adjusts, we will have enough resources to buy good businesses at reasonable prices right at the moment when others are forced to sell. That is not glamorous. It does not create sensational headlines, but that simple and boring way has served me for many decades, and I see no reason to abandon it now. The AI revolution is real. The financial bubble may also be real. Your task as an investor is not to predict who will win the technology race. Your task is to protect capital, maintain discipline, and keep yourself in a position to benefit regardless of which scenario occurs. Right now, that requires more patience than excitement. The market always has a tendency to transfer money from those who act too much to those who know how to wait. Currently, there is a lot of action but very little patience. I know which side I want to stand on. AI will eventually adjust. I do not know when, nor do I know what the catalyst will be, but I know it will happen because history has never given us an exception. And when that day comes, those investors who maintain discipline will be in the best position to move forward. 25 years ago, I was once called obsolete for not participating in the internet fever. I did not change. The market did. This time is the same. I may again be considered someone who does not understand the era. I can live with that. I have heard harsher words than those. A few years from now, when we look back at this period, it is very likely that 2025 will be mentioned just like 1999. With surprise and with the realization that patience has never gone out of style, that is where I intend to stand. I hope when that time comes, you will also stand firm, calm, and safe enough to move forward. Wishing you wise investing, and may God always keep you on that path.